Well, thanks everybody for attending. Indeed, the title of this presentation is Personal Finance Mistakes You're Probably Making. I've been a faculty member at the Yale School of Management, I think for 18, 19 years at this point. And the mission statement of the Yale School of Management is to educate leaders for business and society. And this is not just a marketing BS line that we put out there to look good for the world. This is a statement that faculty kind of regularly come back to when we are discussing the direction, the strategic direction of the school, thinking about new programs to offer. And as I said, I've been kind of around for a while. And if you asked me what I do in terms of research, I would tell an economist I do behavioral finance and household finance research. I don't expect non-economists to know what those terms mean necessarily. And so for years, I just told people who are not economists who ask me what I do in terms of research that I study dumb things ordinary people do with their money. And that's kind of where I left it for a long time. And then at a certain point in time, it occurred to me that maybe I could do something about the dumb part of this. As kind of part of the mission of what we do at school. Maybe through my teaching, I can help people be a little bit less dumb with their money. And so that's where this course came into being, Personal Finance. It's an MBA elective that I teach at SOM. I've taught it for a number of years now. And this is a course that aspires to be unlike any other personal finance course in the world, where we are bringing the best of economic science and evidence to the practice of personal financial management. And so we, this is an actual slide from the course. This is describing the formula for what is the optimal threshold that the interest rate should fall to in order for you to optimally refinance your fixed rate mortgage. So we really are taking the science part seriously. Now, why am I offering this course to MBA students? Well, to a certain extent, maybe their personal financial situation will be improved a little bit because of the course. My sense is that our alumni are going to be, the vast majority of our alumni are going to be just fine in the personal financial realm. And so, that's maybe a minor motivation for me to offer the course. I think a more important motivation for me to offer the course is that our aspiration is that our alumni will go out and kind of be pillars of their community. There'll be people who are seen as sources of wisdom. And of course, it would kind of makes sense that at certain points in time, people in their communities would say, hey, like you probably know something about money and finances. What should I do in this situation? And I want our alums to know something that is scientifically grounded in evidence to guide that advice that they give. Second, there's just been a lot of evidence that's been emerging that there is a kind of a business case for employers to help their employees manage their personal finances better, because there is evidence now that when employees are stressed about their personal financial situations, that spills over negatively into their productivity at work. And so to the extent that employers can help their employees manage their finances better, that's going to be good for the business as well. And businesses have been in kind of the enterprise of helping their employees manage their personal finances. Retirement savings programs are kind of the most visible example of that. But if you're going to be leading an enterprise and helping your employees manage their personal finances better, you have to have a good idea of what better is. And finally, a lot of public policy is about kitchen table issues, which kind of hinge around personal financial issues. And so to be intelligent voters, to be intelligent policymakers, to be intelligent advisors, again, you need to have a sense of what the right thing to do might be. So today, we are not going to be going through this formula. We're going to be doing a much kind of higher overview of some of the topics that this course covers. It is a semester-long course, so 26 80-minute sessions. I'm going to aim to talk for about 45 minutes and then open up for audience Q&A. So we're going to just skirt the surface of some of the things that we cover in the course. I'm going to be talking about financial planning, investing, taxes, housing, mortgages, and insurance, and just picking out some things where I think it's quite likely that people on this webinar might actually be making some decisions that are contrary to what the economic science would say they should be doing. So let's kind of go ahead into financial planning to begin with. Now, when it comes to a financial plan, it seems that a lot of Americans are kind of following the strategy that was described by the father in the Oscar-winning movie Parasite. So towards the end of this movie, as it's moving towards its climax, the father looks towards his son and says, you know what kind of plan never fails? No plan. And if you survey a representative sample of Americans over the age of 50, only a third of them say that they've ever tried to figure out how much to save for retirement. Of that 31% that say that they have tried to figure that out, about 60% say, yes, they did develop a plan. And then another 9% say that they more or less developed a plan. And then of those who did develop a plan, actually a large majority of them say that they were always able to, or mostly able to, stick to that plan. Now, what are the outcomes that are associated with having a plan? Well, it turns out that if you look at median net worth by planning status, those who have no plan have a much lower median net worth than those who were able to develop a plan and then to mostly stick with it or always stick with it. Now, I don't want to claim that these effects on net worth are all causal from having a plan to a higher net worth. Obviously, the type of person who would develop a plan is a fairly different type of person, more conscientious, more neurotic, perhaps, than the type of person who doesn't form a plan. But nonetheless, it's kind of hard to think that you're going to end up in a good place, or that you've maximized the chances of ending up in a good place if you have no plan, if you haven't even tried to figure out, where am I going if I continue to follow the strategy that I've been following. So my most generic piece of advice for everybody is that if you have not created a financial plan, you should do it. Everybody's financial situation is so different, so it's hard to give blanket recommendations that will apply to everybody. But if you just have some projection of where you're going to go from now until your retirement age, that's going to put you in a better place than most Americans. Now, what do I personally do? I have a spreadsheet where I have one row that corresponds to each age that I will be from now until retirement. I have how much I've saved already, how much I plan to save in each year from now until retirement, and then what the asset accumulation I project myself to have is, and I assume a very conservative 1% after inflation return on my investments. And so I can just see, if I kind of do what I think I'm going to do, how much am I going to have accumulated by retirement? And am I happy with that? If I'm not, then that calls for some adjustments. Now, of course, life does not unfold according to plan. All sorts of unexpected things are going to happen between now and my retirement. But if in kind of this expected scenario where nothing remarkable happens, if I'm not on track, even in that very boring vanilla scenario, then there's probably something wrong with my strategy and I should be making adjustments. So make a plan. That's just my most generic and probably most useful piece of advice for you. Now, a lot of people are looking for investing advice because this seems like kind of an easy thing that you can do that doesn't involve sacrifice. I mean, to save more means spending less, and that can be unpleasant. But moving your investments around, that doesn't necessarily feel like a hardship. So we're going to talk about how you might invest the savings that you have. So what I want to do is to give you 20 seconds right now to think about the following two questions. In what percent of years did the US stock market's return exceed the return from holding a one-year US Treasury bill to maturity from 1942 to 2021? That's question number one. Question number two, what was the average one-year US stock market return minus the average one-year US Treasury bill return? And if you don't know what a US Treasury bill is, then you can just think of this as maybe an interest rate on a bank account. So why don't you take about 20 seconds to think about what your best guess is of these two quantities. Okay, have you had time to kind of think about your guess? So the answers to these questions may surprise you. So for the first question, the answer is 71%. In 71% of years, the stock market beat the return from holding on to a safe, risk-free investment. And then the average one annual return of the stock market versus that safe return, that average is 8.9%. So if you are like most people, you were probably too pessimistic about what the historical performance of the US stock market has been. Indeed, I have data to back this up, not just anecdote. This is a graph that shows the results from a recent study where a representative sample of Americans were surveyed about what do they think the probability that the stock market is going to go up over the next 12 months. And what this graph shows is what is the gap between the average response to that question and the historical probability that the US stock market actually went up over a 12-month period. And what this graph does is it breaks up the sample by income percentile. So people on the left here, so this is people who were in the first income percentile, so basically the bottom 1% of income, and over here is people in the top income percentiles, the very highest income people in the population. And so if you look at this graph, what you'll notice first is that all the income percentiles are below zero in this difference between their average response and historical average. So everybody is more pessimistic about the next 12 months than what the historical experience of the stock market return has been. Second, there's this quite striking linear relationship where people who are lower income are more pessimistic, in other words, maybe more over pessimistic about the stock market's performance than people who are high income. So to the extent that the US stock market has been this fantastic investment over the last 100 years, this kind of compounds the disadvantage that low income people have because they seem to be too pessimistic about the stock market, and so that makes them more reluctant to invest in the stock market. But even the highest income people on average are too pessimistic. Now, there's no kind of guarantee that the US stock market's performance in the future will match its performance over the last century. It has been a fantastic century for US stocks. But that being said, there has also been a study that's found that if you're trying to predict next year's stock market return, it is very hard to beat a prediction that is simply what is the average stock market return up to this point. Okay, so simply guessing the historical average is probably the best stock market predictor that you can come up with. Now, what does this all kind of mean for your own personal portfolio allocation? Well, you might be surprised to learn that standard economic models recommend a very aggressive portfolio allocation. In fact, 100% stock allocation through your 50s, and that's even if the stock market's average return going forward is considerably lower than what it has been historically. Now, why is this? It's because actually your financial portfolio, the amount of money that you have saved up so far, for most people is only a small portion of the total economic resources that you are going to command over the course of your lifetime. By far, the most important economic asset that most people on this Zoom call will have is their human capital, the future labor income earnings, the wage earnings that they're going to have from now until retirement. So when you're doing your asset allocation for your financial portfolio, you should be taking into account the fact that you have this big asset sitting in the background. And now the question is, how should we think about that human capital asset? And it turns out that it's kind of more like a bond than a stock. So it's true that there is some variability in your wage income earnings over time. There is some risk, but that risk is to a large extent uncorrelated with the stock market, and actually not that large in this scheme of things. And so if you think about your human capital as this enormous implicit fixed income position and this enormous implicit bond holding, then that means that in your financial portfolio, you can take a lot of risk. In fact, you should take a lot of risk because you have this huge buffer sitting in the background in your human capital. Now, it is true that as you age and as you get closer to retirement, the value of that human capital, the present discounted value of your future labor income earnings is going to shrink. So that implicit safe asset that you have in the background is going to get smaller and smaller and smaller. And so then you should adjust your financial portfolio to become more conservative to offset the fact that you have less of the safe background asset in your overall economic portfolio. But when you kind of do the math, it turns out that at least the standard economic models say that you really shouldn't be kind of coming off that 100% stock allocation until you're well into your 50s. Okay, so now that we have kind of thought about the overall asset allocation in terms of asset classes, stocks versus bonds versus cash allocation in your portfolio, which stocks should you be holding? And if you're like a lot of people, you kind of want to do a little bit of stock picking in order to beat the stock market, because who wants to just perform like the average investor? Now, you might have heard that it is really hard to beat the stock market, but I think this particular study shows why it's so hard to beat the stock market overall. And it's because if you look historically since 1926, the best performing 4% of stocks account for the entire gain of the US stock market. And the best performing 0.3% of stocks account for half of the stock market's wealth creation above the treasury bill. And the remaining 96% of stocks collectively match the US treasury bill's return. So if you're trying to just pick a small number of stocks to beat the overall market, well, you are really looking for needles in the haystack, because it's only a tiny fraction of the market actually beats the US treasury bill. So this is really an argument for diversifying and for actually having passive investments, because by having a broad spectrum of stocks in your portfolio, you're going to have the best chance of having that those 4% of stocks, or the 0.3% of stocks, that play an outsized role in wealth creation through the stock market. Now, a lot of us aren't going to be picking individual stocks, or at least not for the bulk of our portfolio. But what we're going to do is we're going to delegate the portfolio management to mutual fund managers, or ETFs. And as most of you know, there are two flavors of mutual funds, or ETFs. There are actively managed funds that are trying to beat the stock market, and then there are passive funds that are just trying to match the returns of some stock index. Now, as a whole, the actively managed mutual fund sector underperforms the market by about 0.67% per year on average. So, not everybody can be above average, of course. And so on average, actively managed funds are average. Before the fees they charge, then the fees they charge are so high that on net, they are losing money for their investors, or at least on average. Now, you might say, well, that's the average fund, but of course, I'm not going to invest in the average fund. I have very simple tastes. I am satisfied with the best. So what if we tried to identify the best mutual fund managers and invest our money with those active managers? So that kind of brings up the question, how would you identify the best managers? Now, in most domains of life, the following rule of thumb holds, which is if you are on the playground and you're trying to pick a basketball team for a pickup game, and you see some player on the court that during practice is dunking, is making three-point shots from all over the court, I have a pretty good bet that that player is a very desirable player to pick for your team. So in most domains of life, past performance is quite a good predictor of future performance. So the question is, for mutual fund managers, is that the same? Does that also hold true? And so we can actually engage in a data exercise where we go year by year, and each January 1st, we can sort all actively managed US equity mutual funds by their past year returns. And then we can try one of two strategies. Either invest our money equally among every fund in the top 10% of the past year's returns, or invest equally in each fund in the bottom 10% of past year returns. So you would think this past winner strategy, that's, those are the fund managers that have some skill, and these are the losers who you should try to avoid. So let's look at the difference between the returns of these two strategies. So what I'm going to plot here is a 10-year rolling average monthly difference in the alphas between those two strategies. So what's an alpha? You can think of it very loosely as outperformance. So even more loosely as the difference between the performance of the strategy and the S&P 500 or the US stock market as a whole. And what we're showing here is the difference in the alpha from past winner strategy versus past loser strategy, averaged over the past 10 years, ending in 1972. So from 1963 to 1972, what was the monthly outperformance of that past winner strategy over the past loser strategy? And here's kind of a surprise, which is that strategy did very well from 1963 to 1972, kind of over a 1% per month outperformance. So you might have heard that past performance is not a reliable indicator of future performance, but gosh, like there was a time at the beginning of the sample where that was a pretty good strategy. But now if you plot that series over time, you can see that the returns to that past winner strategy have really collapsed over time. And by the time you get to 2011, that the prior 10 years of that strategy has kind of netted you zero, and then it goes negative over the subsequent 10 years. So what does this data point here indicate? That's the returns from investing in that past winner strategy rather than the past loser strategy from 2003 to 2012. And so at least since 2002 or 2003 up to the present, this strategy of chasing the past winners has just not been profitable at all. And so for the past 20 years, this going for the past winning mutual fund managers has just not been a good idea. Now, as kind of an aside, what was going on in this period here, where the past winners were outperforming in the following year, there's evidence that this isn't really about those fund managers actually having skill. It's just that they happened to be lucky in that year. So they happened to hold a lot of stocks that went up. And there is this phenomenon known as individual stock momentum, where stocks that have done well in the past year continue to do well over the next year. And so you just happen to hold a lot of these high momentum stocks in your portfolio by luck. And so then your portfolio tends to do a little bit better over the next year. That's what we think is really happening in this old period. But the returns to these momentum strategies have really diminished a lot over time. And so that's what we were seeing over here, where there's not really skill that was manifest in that earlier period. It just kind of the luck of having these high momentum stocks in the portfolio. Okay, so now we're going to move on to taxes. And one thing that might strike you as quite a natural thing to do when you're choosing your asset allocation is to follow what you might call a fractal strategy. So all of us, or many of us on this call, probably have some retirement assets, retirement savings assets that are in a tax advantaged account like a 401k or an IRA. And then we have some assets that are sitting outside of these tax advantaged accounts in kind of regular brokerage accounts, let's say. And so a very natural strategy is to have the exact same asset allocation in your retirement accounts as in your non-tax advantaged accounts. Turns out that that's not the right strategy to follow, because certain assets have a systematically higher tax burden than others. So in fact, if you rank assets from the lowest tax burden to the highest tax burden, well, municipal bonds quite obviously have a very low tax burden because their interest is tax exempt. And then the next lowest tax burden asset class would be passive equity funds. Why do I say passive? It's because these funds tend not to trade very much, so they don't generate a lot of taxable income, and so they're actually quite tax efficient vehicles. Next up is taxable bonds. These are actually relatively high tax burden because they're going to pay an interest coupon to you or interest payment to you every single year. And so you have no option of deferring that income if that bond is sitting in a taxable account. And then the highest tax burden account is an active equity mutual fund, because that's trading a lot, and so that's going to generate a lot of capital gains that are taxable for you if you're holding that. So what you want to do is to stuff as much of the high tax burden assets into your 401k, into your IRA as you can, and keep the low tax burden accounts outside of your 401k and IRA. And so if you're following kind of a bond and passive equity fund strategy, to put as much of your bonds as you can, your non-muni bonds, into your 401k and IRA, and then put kind of the rest of your assets into the taxable accounts. Another tax decision that a lot of us have to make is the choice between making a before-tax 401k contribution and a Roth 401k contribution. So let's take two individuals. Amy makes only before-tax 401k contributions, and Barbara makes only Roth 401k contributions. If they are otherwise completely identical to each other, who should have a higher 401k contribution rate, Amy or Barbara? Take 15 seconds to think about this. Now, kind of the default answer that most people come up with is, you should probably contribute about the same, regardless of whether you're doing before tax or Roth. And that's actually the wrong answer. Why is it the wrong answer? It's because before tax 401k balances are taxed at the ordinary income tax rate when they're withdrawn, whereas Roth 401k balances aren't taxed at all when withdrawn. So with Roth 401k contributions, you get the tax break kind of at the end when they're withdrawn. You're not taxed at that point, but you don't get a tax break up front. Whereas with the before tax 401k contribution, you get a tax break up front, but then you get taxed at the end. But what that kind of means when you look at $1 of balances in the Roth, that's actually worth more than $1 of balances in the before tax 401k, because that dollar in the Roth, that full dollar can be used to finance retirement consumption. Whereas the dollar in the before tax 401k, you can't use that full dollar on yourself. When you withdraw it, you're going to be able to use 1 minus the tax rate dollars. You're going to be able to use that amount for your retirement consumption. So what that means is that Amy, who's making the before tax contributions only, should have a higher contribution rate than Barbara, because the dollars that she's putting in are worth less than what Barbara is putting in. So that's, I think, somewhat a surprise for a lot of people. Now, that leaves open this question of, should you be making your contributions in before tax versus Roth? And that's a very hard question to answer, because it depends on whether your marginal tax rate is higher today versus when you're going to withdraw it, probably decades from today. But it turns out that for at least a subset of people, the answer to this question is quite easy. And I suspect that maybe many of the people on this call fall into this category where this problem is quite easy. And so I'll share what you might want to do in this case. So if you are fortunate enough that you are able and want to save a lot in your 401k, such that you are constrained by the IRS's annual limit on how much money you can put into your 401k, then absolutely you should be making all Roth contributions. And that's because a Roth dollar is worth more than a before tax dollar. And that $22,500 limit applies equally to Roth and before tax contributions. And so you want to put in as much of those dollars as Roth as possible, because $22,500 of Roth balances is worth more than $22,500 of before tax dollars. So there are many things that are kind of nice about being high income. One of them is that certain questions on taxes become simpler to figure out. Let's talk about housing. This is the most important asset that many people have on their balance sheets. And I think there's a lot of confusion about housing, and it is a hard thing to think about. Now, one thing that you hear a lot when it comes to housing is that if you rent, you are throwing money away every month when you write that rent check, versus if you have a mortgage and you're building up equity in the home and so on. And so actually everybody who is a prudent financial manager of their own personal affairs should aim to own their own home. Now, if you stop and think about this, like an economist, you have to come to the conclusion that that trope that renting is throwing your money away just cannot be true. So think about stock that pays dividends over time. So what is the amount of money that you'd be willing to pay for a share of the stock? Well, it's the present discounted value of all those future dividends that you are going to receive from the stock. So similarly, when you are thinking about buying a house, you are paying upfront for the present discounted value of all the net benefits that you get from the house. So just to kind of put it in a little bit more precise terms, in a frictionless market where all the prices are right and there are no taxes and there are no transactions costs, et cetera, the purchase price of a house is going to equal the present discounted value of all the rental payments the house could earn over its useful life. And if you're an owner, that means the rental payments that you would not have to make because you own the house, minus the present discounted value of all the costs that are paid by owners but not renters. So this would be stuff like maintenance and property tax. So what that implies is that at least in the frictionless market, you should be completely indifferent between owning versus renting a house. Financially, it's just completely the same. Now, of course, we don't live in a frictionless market. So the price of houses could be out of whack at any point in time. And so it could be that systematically houses are underpriced for purchase. And so anybody who can purchase a house should. A little hard to think why that would be, but that's in principle possible. So let's kind of look at how housing investments have worked out in the residential market over time. So this is the Case-Shiller index of overall U.S. Real home prices. This is Shiller here is our own Bob Shiller. And quite strikingly, what you see is that over most of the 20th century, real house prices were basically flat. So there was no capital gain after inflation from owning a home. And then something interesting happened starting in the late 90s, where house prices have gone up quite a bit, even after inflation. So, I have kind of taught this graph to the students in my course, said, look, we don't really know what's happened out to the right of the graph. We don't know if this is going to kind of continue or if we're going to return to trend. But at least something has changed, has been different in the last few decades. Now, what I did not do the first number of years that I taught the course is actually compute what was the return, the annual return on the right-hand side of that graph, where house prices seem to have gone up in real terms. Turns out that that annualized return is 2.5% per year. Okay, so that's not like this enormous return. And what this does not take into account is maintenance costs and property taxes. To be fair, it also doesn't include kind of the savings that you get from not paying rent. But this is not what I would characterize as an astronomical return on housing. Compare that to the stock market's return, for example. But what about a more comprehensive view of housing financial returns, so including the rental savings, including the property taxes, and the fact that for each of us, we don't actually own the entire housing stock of the U.S. We don't have a diversified investment in that entire market. We own one home typically. If we're kind of very well off, might own 2 or 3 homes, but we're basically not taking diversified positions in the residential housing market. So this is a recent paper from two economists at Berkeley, which did this amazing job of scraping together 7.1 million home ownership spells that involved a mortgage loan from 1990 to 2020. The nature of the data is such that the vast majority of the spells started in 2000 or later. So they computed what the returns to owning housing were, and quite striking facts. So first of all, overall, the net returns on housing, including the fact that you're levered, so you borrowed money to invest in the home, to buy the home, and so your returns are magnified. On average, those annual returns are 3.9%. So again, not astronomical. And then quite strikingly, there are these large racial differences in the returns that people have realized from housing, where for Blacks and Hispanics, that financial return has actually been negative. Now, what's going on here? It turns out that for Blacks and Hispanics, they are disproportionately likely to end an ownership spell by selling their home under distress, so under foreclosure or in a short sale. And when you're selling an asset under distress, you're just not going to get a good price for it. And so they end up losing a lot of money in these distressed sales. Now, the authors of this study run this counterfactual exercise where they say, what if the rate of distressed sale were equalized to the white rate for all races? In that counterfactual scenario, Blacks and Hispanics would have actually had a higher average annualized return because they disproportionately live in these urban areas that have benefited from gentrification and the urban renewal over the last few decades. So what do I take away from this? I think that it's kind of a mistake to push people into home ownership by telling them they should stretch their budgets and really buy as much home as they can, because buying the home is kind of this ticket to financial security. To be house rich, cash poor is a very precarious place to be. And if it ends poorly for you by ending with you making that distress sale, it's going to be a financial loser for you. Also, an interesting fact that comes out of this paper is what is the standard deviation or the riskiness of this home ownership? So you should look at the gray bars here. This is the standard deviation of the returns, including the effects of the leverage of the mortgage loan. So the annualized standard deviation is like 37% per year. To put that into perspective, the annual standard deviation of a stock market investment on the overall US stock market is kind of in the neighborhood of 20% per year. So housing is actually a quite risky asset from a financial perspective, because there's just a lot of idiosyncratic uncertainty about what the return on your individual house is going to be. So overall, my take on this is if you're renting, I'm pretty relaxed about it. You shouldn't kind of think that you are losing a ton of money by renting. In a frictionless market, it's just not going to make any difference at all. And even in the real world, it's not quite clear that you're losing from renting. Now, do I think that everybody should rent? No, because the type of house that you are able to buy in the US is quite different from the type of house that you can rent. So there are certain houses, a lot of houses, you can really only buy. You can't really rent them economically. And so if the type of house you want to live in is the type of house that you have to buy, then go ahead and you can buy. But if you are happy living in a unit that is available for rental, then I would kind of be relaxed about that. And then really you should beware of stretching your budget to afford the house that you're going to move into. If you're kind of hitting zero on your checking account balance every month, or you face the prospect of hitting zero on the checking account balance at the end of every month because you've stretched to afford the mortgage, maybe that's not a good idea, and maybe you should just rent for longer until you have the financial margin to comfortably afford your mortgage. Let's move on to mortgages. So here there's a big choice that one has to make between fixed rate and adjustable rate mortgages. Now, if you don't really think about it for too long, it seems intuitive that fixed rate mortgages are safe, because what could be safer than a fixed interest rate, a fixed nominal monthly payment, But as soon as I insert the word nominal in there, you realize, aha, actually these things have risk because there's this thing called inflation lurking in the background. So if the payments are fixed nominally, that means that the real payments, the inflation adjusted payments, are not fixed. So if you are a fixed rate mortgage borrower, you love it if inflation is unexpectedly high, because that means the real value of your future debt payments is being eroded away. Now, on the flip side, if inflation is unexpectedly low after you take out your fixed rate mortgage, you're protected there as well, because often the nominal interest rate will fall, and then you can refinance your mortgage at a lower rate. So that's good. But it's in the middle where inflation is surprisingly moderate that a fixed rate borrower is hurt. So there are some real risks here. And then, there's a benefit as well. If the real interest rate rises, then you are in a good position if you are a fixed rate borrower. And that's kind of where fixed rate borrowers are sitting in today's economy. Now, for an adjustable rate mortgage, this feels risky because the monthly nominal payment moves around. But if you kind of do the math, it turns out that the present discounted value of an adjustable rate mortgage's payments is nearly insensitive to inflation. So in that sense, adjustable rate mortgages are safe, but there are also risks that are associated, their own set of risks associated with ARMs. So one is, if you're sitting here today and the expected inflation rate rises unexpectedly, then the nominal interest rate is going to rise today. That means your monthly payment is going to rise today, but the price level hasn't risen yet. So your salary hasn't increased yet in nominal terms. And so your real monthly payment will increase in the short run. And so that's called payment shock. So if your budget is not kind of resilient enough to be able to handle a temporary increase in real mortgage payments, then an adjustable rate mortgage is going to really hurt you. And then the last point here is that if the real interest rate rises, then under an ARM, you're going to be hurt. So what does an economic model recommend, kind of putting all these forces together? Actually, it recommends that you should go with an ARM, usually, unless you're really stretching your budget to afford your house, and so you can't handle that real payment shock. Now, why does the economic model like an ARM? Well, it's because on average, ARMs offer you a lower interest rate. And why do ARMs offer you lower interest rates? Because ARM interest rates tend to be pegged to a short-term borrowing rate, whereas fixed rate mortgages are pegged to longer-term interest rates. And in most economic circumstances, long-term interest rate is higher than the short-term interest rate. Now, we're living in a time right now where that's not true, where that yield curve is kind of flat or maybe even slightly decreasing. And so right now, actually, is a fairly good time to be in a fixed rate mortgage instead of an ARM, because the ARM interest rate is not cheaper. But even 6 months ago, I think that the ARM interest rate was cheaper than the 30-year fixed. You might know that at SOM, we have this core course called Competitor that is kind of teaching about competitive market dynamics. And you would think that the mortgage market is a perfect example of a nearly perfectly competitive marketplace, because there's so many banks and lenders that are competing to make mortgage loans. And so if you ask people who have borrowed a mortgage recently, like, do you think that you basically got the best deal that you could, and that pretty much everybody offers the same interest rates and fees? People say, yeah, I probably got the best deal, and everyone's offering the same interest rates and fees. Turns out that that is so not true. So you can actually look at data and look at the offers that mortgage lenders are willing to kind of give across different lenders for people who look identical on all the relevant variables that are used for the underwriting decision. Turns out there is a large interest rate dispersion across lenders. So this is something that shows up again and again in consumer lending markets. In fact, again and again across consumer financial products. It pays to shop around. So I would recommend, if you're in the market for a mortgage, to get at least 3 quotes, because those quotes can be quite different from each other. Last thing I'll talk about is insurance, and then I'll open up for Q&A. I'm going to talk only about health savings accounts. These are savings accounts that you can contribute to if you're in a high deductible health plan. About a third of Americans have HDHPs. And HSAs are kind of this remarkable vehicle because you contribute using before tax money. That money grows tax-free like a 401k or IRA. And then if you withdraw it, that withdrawal is not taxed if you spend it on a qualified medical expense. And so that money completely escapes taxation. This is the most tax-advantaged savings vehicle that we have in the United States. Now, if you're like most people, including me, the obvious way to use an HSA is you request an HSA reimbursement for medical expenses immediately. Isn't that what they're for? It turns out that this is not the optimal way to use HSA. So the optimal ninja strategy for using HSA is to realize that there is actually no time limit on when you can request reimbursement from your HSA for a medical expense that's incurred in any given year. So you could request the reimbursement 20 years after the expense is incurred, as long as you have the receipt in your records in case you get audited by the IRS. So what you should do is you pay for that medical expense this year using taxable account balances. You keep that money in the HSA. You allow that money to grow tax-free in the HSA, say for 20 years. And then later on, 20 years from now, when you need that money, you reimburse yourself from the HSA when you need that liquidity. And so what you're effectively doing in this strategy is you're transferring money in the tax disadvantaged account sitting outside the HSA and putting more money into the HSA because you're not spending the HSA money now, you're spending the tax disadvantaged money today instead. Okay, so to summarize what I covered in the past 45 minutes, have a financial plan. Be aggressively invested in equities through midlife. Avoid active stock picking. It's very, very hard to beat the stock market. Think about which assets you have that are most tax disadvantaged and stuff those assets into your tax advantaged accounts like your 401k or IRA. Remember that $1 of Roth balances is worth more than $1 of before tax balances. That means if you are up against that 401k annual contribution limit, then you should be contributing probably in Roth dollars rather than before tax dollars to maximize the buying power that you're getting from your 401k contribution in retirement. Buy a house to live in it, not to get rich. Do not be house rich, cash poor. These episodes have these circumstances have a high likelihood of ending poorly for you financially and otherwise. ARMs are usually preferable over fixed rate mortgages if you are not stretching your budget to afford your house. Right now is an exception to that rule because of the shape of the yield curve, the fact that long run interest rates are about the same or maybe even a little bit lower than short run interest rates. Pays to comparison shop for financial products. And finally, wait to reimburse yourself from your HSA. So with that, I'll open up for questions. I think that Brendan is going to curate this for me.
Yes. So James, let's start with this one. Given the state of Social Security projections, should Americans consider Social Security income in our financial planning?
Absolutely. So one of the striking things about Americans is that even if you ask Americans that are just a few years away from being able to claim Social Security, a large fraction of them say, I don't think I'm going to get a dime from Social Security. This is, I think, a completely irrational expectation. And the case study that I would offer to you is Greece. In the wake of the 2008-2009 financial crisis, Greece went through pretty much the worst economic circumstances you can think of. Basically, it was like as bad as, or maybe even worse than the Great Depression was for the United States. Did Greece get rid of their Social Security benefits altogether? No, not even close. So there are a lot of older Americans that depend completely on Social Security for their retirement income. And so if you got rid of it altogether, there would be people starving on the streets. So politically, this will never happen. Now, do I expect Social Security to be less generous in future decades? Yeah, I do think that they'll probably get less generous, especially for people who have had high lifetime incomes. But to expect it to be zero, I think is just not in the feasible political set.
Awesome. Thank you. So this question from Tanmay Manohar, who's an alum and chapter leader in New York City. He says, "Hi, Professor Choi. Thanks for hosting this. You mentioned that somebody constrained by the 22,500 annual 401k contribution limit should make Roth contributions. What if you're currently in the highest tax bracket and anticipate being in a lower one, notwithstanding that the government could increase tax rates in the future in retirement? Is there a scenario in which the tax savings now could make the $22,500 into a traditional 401k worth it, or is Roth always the dominant strategy when maximizing contributions?"
So, without doing the arithmetic and kind of doing the entire range of tax scenarios, I think, there's always a chance that once you do the arithmetic, you discover that, the Roth is going to be the way to go, or the before tax is going to be the way to go. But I think that my sense is that for most feasible tax paths, the value of being able to stuff more effective purchasing power into the 401k by doing the Roth contributions is going to outweigh kind of those differences in tax rates that you might expect, especially because future taxes are so uncertain. And so that's really quite uncertain bet, whereas kind of that difference in the purchasing power you're buying from the Roth contributions, I think that's kind of the first order consideration in my book.
Awesome. Okay. So here's an interesting one, maybe. If housing is so risky, why are the returns so low?
I think part of it is there is this mythology around home ownership that causes people to want to own homes. There's a lot of government programs that promote home ownership. But then, I think there's also this non-financial return you get from a home. Some people, and not me, but some people just get this great sense of satisfaction from owning their own home, being master of their domain. So that, that naturally is going to increase the willingness to pay for a home. So that non-financial dividend is part of the return from owning a home. And if you don't get that non-financial dividend, you couldn't care less about owning your own homestead, then that's just a pure loss for you. So I think that it's really kind of the mythology and the psychological benefits or the psychological pleasures that you get from owning a home that account for the low rates of return.
So there's a few questions, more than a handful, I would say, that people are still stuck up on the potential for equity. So one is in owning a home. So I want to give you a chance to speak about that again, just because someone said something along the lines of, but if you live long enough to pay off the mortgage, then having bought a house was clearly better than having to continue to pay rent. Can you speak to that again? Just because it seems like there's some confusion in the comments.
Yeah, so I think that it's if you think that the price of buying a house is the present discounted value of the rent that you would have otherwise paid for that home, that's kind of the market's assessment of what is the indifference point between giving up all that money up front to buy the home versus having to have the stream of rent payments over the infinite future.
Awesome. And then there's a few questions about Social Security. How should people start to think through when they should take Social Security out?
I think the fairly universal economist recommendation is that if you are in reasonable health and you have some outside assets, which everybody I think should, then you should try to take Social Security as late as possible. So take it at age 70 and spend down your assets that are not your non-Social Security assets to finance those gap years. And the reason is that Social Security is this fantastic asset. It is something that gives you longevity insurance because it continues as long as you live. It's inflation indexed. It is backed by the U.S. government, which is very, very creditworthy. And so it's a life annuity that's the best life annuity that's available in the world. And so if you delay taking Social Security, you're increasing your monthly benefits over the remainder of your life, the longer you delay taking that. And so you're effectively purchasing more of this fantastic life annuity by claiming as late as possible.
There's a few questions about life insurance. Do you have any thoughts on life insurance?
So maybe I'll make myself unpopular with some of the listeners on this call, but generally the thought is you should buy term life insurance and avoid any life insurance that has a kind of a cash accumulation property, like whole life insurance. So these are these products that bundle together insurance and savings, and they generally have very high fees and are actually not that attractive from a financial point of view.
Thank you. A couple questions about book recommendations on behavioral finance. Do you have any that come to mind?
Book recommendations on behavioral finance. I mean, there's a lot of aspects of behavioral finance, investing versus kind of more on the individual level. Nudge by Cass Sunstein and Richard Thaler is an obvious classic in this arena. On kind of the investing side, honestly, nothing comes to mind immediately, but I'm sure as soon as this call ends, I'll remember, oh my gosh, I should have said XYZ, but I don't have something off the top of my head.
Sure. There's obviously our alumni community is all over the entire world, and there's a few questions about how do I take this advice and sort of, if I don't live in the US, what should I be thinking through in terms of adapting it generally?
Yeah, so in my course, I make very clear that it's a very US-centric course because I want it to be practical, and any personal finance strategy depends crucially on the rules of the system within which you're working. So if I tried to make the course quite universal, then I think it would become less useful, practically speaking. I think for somebody outside the US, the advice about equities and how your human capital relates to your financial portfolio allocation, I think that's a pretty universal piece of advice. Just kind of, unless you are like an investment banker where your bonuses depend a lot on the return of the stock market, pretty much your human capital is probably more like a bond, and so you should be fairly aggressive in investing in stocks in your financial portfolio. Other than that, I think that a lot of things depend. Also having a financial plan, I think that's a fairly universal piece of advice as well.
So there's a couple of questions where folks are curious about your thoughts on annuities, just very broadly.
So annuities have the unfortunate property of referring to a bunch of different kinds of financial products that are loosely related to each other. I'll say that the one type of annuity that economists really like is something called a life annuity. These are annuities that you hand over a sum of money up front, and then the insurance company makes a regular payment to you for the rest of your life. And what this provides is longevity insurance, insurance against outliving your savings. So there is a very famous paper written by a former Yale economics professor from the 1960s saying that at least under certain idealized circumstances, you should put all of your money into an annuity because you can't take the money with you when you die. And because the insurance company takes the principal from people who die early, that can be used to subsidize payments to people who die late. So life annuities are this fantastic product, and it's been a decades-long puzzle that economists have kind of worked on, that people seem to really not like life annuities. So Social Security is very, very popular. Social Security is the ultimate life annuity. But other than that, in the private market, people just don't seem to buy this stuff, and we're not quite sure why.
It's really interesting. If income limit prevents investment in IRAs, what would you recommend related to retirement savings?
There is no income limit to investing in IRAs. You might be thinking about the income limit for contributing to a Roth IRA. Now, it turns out that there's a lot of confusion about this, but even for the highest income individual, they can make Roth IRA contributions. Just Google backdoor Roth IRA, and you'll see how to do it. It's super easy. It takes about 5 minutes to do.
So we're right at 1. Could I ask you one last question, Professor Choi? Okay. Should your allocation between stocks and bonds differ in your retirement saving account versus an outside savings account or an outside account investment?
Yeah, well, this is the asset location problem where you want to put your most highly tax burdened accounts or assets into your retirement savings account. And so to the extent that you do hold bonds, you should try to hold them in your 401k. And then if there's still room in your 401k, you might hold some stocks in the 401k as well. But then the remainder of your stock allocation should spill over into your taxable accounts, because at least if you're going with my advice and going with passive equity funds, then these are relatively low tax burdened assets. And so that's what you want to hold in the non-tax advantaged accounts.
Well, I want to say on behalf of the entire alumni community, Professor Choi, thank you so much for your time today. It's been an illuminating discussion.
It's been a lot of fun to engage with you guys, and look forward to having more interactions in the future.
Thanks so much. Take care.